Real estate has long been touted as a lucrative investment avenue. The allure of tangible assets, potential for appreciation, and rental income is undeniable. However, the traditional route of buying property comes with its own set of hurdles. Large down payments, ongoing maintenance, and the complexities of tenant management can be daunting for many aspiring investors. Fortunately, there are numerous ways to tap into the real estate market without directly owning property. These alternative investment strategies offer varying levels of involvement, risk, and potential returns. Whether you're seeking passive income, portfolio diversification, or something in between, there's an option out there for you. Navigating these alternative investment methods can be complex. Understanding their intricacies is key to making informed decisions aligned with your financial goals and risk tolerance. Real estate investment trusts, or REITs, provide a convenient way to invest in real estate without the burdens of property ownership. REITs are companies that own, operate, or finance income-producing real estate. They are traded on major stock exchanges, offering a high degree of liquidity. REITs come in various flavors. Equity REITs own and operate income-generating properties like shopping malls and apartment buildings. Mortgage REITs provide financing for real estate projects. Hybrid REITs combine elements of both equity and mortgage REITs. One of the most appealing aspects of REITs is their potential for generating passive income. REITs are legally obligated to distribute at least 90% of their taxable income to shareholders as dividends. This makes REITs particularly attractive to income-focused investors. However, REIT prices can fluctuate, and their performance is often tied to interest rate movements. Real estate crowdfunding has emerged as a game changer, democratizing access to real estate investment. These online platforms connect investors with real estate developers and operators seeking funding for various projects. Crowdfunding platforms typically offer two primary models: debt-based and equity-based. Debt-based crowdfunding involves lending money to real estate projects in exchange for regular interest payments. Equity-based crowdfunding grants investors fractional ownership in a specific property or portfolio. Crowdfunding's appeal lies in its relatively low investment minimums, often starting as low as a few $100s. This accessibility opens doors for a wider range of investors to participate in potentially lucrative real estate ventures. However, it's crucial to remember that crowdfunding investments are often illiquid, and platforms may charge fees that impact overall returns. Section 4 REGs, pooling resources for passive income. Real estate investment groups, or REGs, provide another avenue for passive real estate investment. REGs pool funds from multiple investors to purchase and manage rental properties. They offer a hands-off approach, handling property management, tenant screening, and rent collection. REIGs can be structured in various ways, from limited partnerships to limited liability companies. Investors become passive partners, benefiting from rental income and potential property appreciation. However, REIGs often come with management fees, and their illiquidity can be a drawback for investors seeking short-term gains. Understanding the track record, fee structure, and investment strategy of REIG is critical before committing funds. Thorough due diligence is essential to mitigate potential risks. Section 5. ETFs and mutual funds. Diversifying your real estate portfolio. Real estate ETFs and mutual funds offer a diversified approach to real estate investment. ETFs, or exchange-traded funds, track the performance of a specific real estate index, such as the FTSE Nareit et al. REITs index. Mutual funds, on the other hand, invest in a diversified portfolio of real estate assets. Both ETFs and mutual funds provide instant diversification, spreading your investment across multiple properties and geographic locations. They are also highly liquid, allowing investors to buy and sell shares on major stock exchanges. While ETFs and mutual funds offer convenience and diversification, they are subject to market volatility and may come with expense ratios that can impact returns. It's essential to research and compare different ETFs and mutual funds to find those that align with your investment goals and risk tolerance. Section 6. Alternative strategies and choosing your path. Beyond REITs, crowdfunding, REIGs, ETFs, and mutual funds, several other strategies allow you to engage with the real estate market without directly owning property. Wholesaling involves finding undervalued properties and assigning contracts to other investors for a fee. Tax liens present opportunities to acquire properties at a discount by purchasing delinquent property taxes. Private lending involves providing loans to real estate investors, typically secured by the property itself. Real estate limited partnerships, or RELPs, allow investors to pool funds for specific real estate projects. Choosing the right real estate investment strategy is a personal decision. Factors to consider include your investment goals, risk tolerance, time horizon, and the amount of capital you're willing to invest. Each strategy comes with its own set of advantages and disadvantages. Thorough research, due diligence, and potentially seeking advice from a financial advisor can help you make informed investment decisions aligned with your overall financial plan. Remember, real estate investment, whether direct or indirect, carries inherent risks. Market fluctuations, economic downturns, and unforeseen circumstances can impact returns. Diversifying your investment portfolio and approaching real estate investment with a long-term perspective can help mitigate potential risks and enhance your chances of success. Thanks for watching. Please like, subscribe, and leave a comment. Let us know what kind of videos you would like to watch next.